Hello everyone and welcome back to the channel. Today I'm going to evaluate all of the magnificent 7 stocks and put them in one of the 5 categories of extremely overvalued, overvalued, slightly overvalued, fairly valued, or slightly undervalued. Even if you're not following the stock market, you definitely know all of these companies: Apple, Microsoft, Google, Amazon, Meta, Nvidia, and Tesla. These tech giants have been absolutely dominating the market, driving a significant portion of S&P 500's gain. Their collective market cap is accounting for almost 1/3 of the total market value of the entire US stock market. This concentration of wealth and performance is both exciting and for some a little concerning. I am going to dive deep into their valuations, look at different metrics, and try to understand if these mega cap stocks still have room to run. So if you're holding any of these stocks, or if you think about buying these companies, stick around. When I talk about valuation, I am trying to figure out if a company's stock price reflects its true intrinsic value or if it is trading at a premium or a discount. The metrics that I'm going to use today are price to earnings ratio, which is probably the most common ratio you ever seen. It tells you how much investors are willing to pay for each dollar of a company's earning. Then I use forward PE, which is similar to price to earnings but uses future earnings estimates. Then I look at price to operating cash flow. This is the key metric for me. Operating cash flow is the cash generated from the company's normal business activities. Unlike net income or earnings, operating cash flow is very hard to manipulate with accounting rules. So the price to operating cash flow tells you how much you pay for each dollar of pure cash generated by the business. To me, this is even better than price to free cash flow, as a lot of these mega cap stocks are investing heavily into their infrastructure, especially AI infrastructure, and therefore price to operating cash flow is a better metric to look for in these companies. Then I look at return on equity. This is a profitability metric. It tells you how much profit the company generates for every dollar of shareholder equity or investment. And finally, return on assets, which measures how efficiently a company uses all of its assets, including debt and equity, to generate profit. So we need to look for sweet spot: high return on equity, high return on assets, and strong revenue and operating cash flow growth, but a price to earning, forward PE, and price to operating cash flow that aren't excessively high relative to the growth of the company. Okay, let's start with Apple. Apple's share price grew almost 900% in the last 10 years, which is nothing short of incredible. Apple market cap is now $3.8 trillion. That's a massive company. Let's first look at growth numbers. The revenue in the last 10 years is grown by only 5.8% CAGR, and it is actually pretty much flat in the last couple of years. They somehow reignited their growth last quarter, but the growth seems to be slow for Apple in the top line. The Apple revenue is very stable though, especially due to its service businesses, which means the revenue is predictable and stable. When we look at operating cash flow and free cash flow growth, we can see similar numbers, around 5% CAGR growth for operating cash flow and a bit better for free cash flow. Despite a slow growth, Apple is aggressively buying back shares. In the last 10 years, they reduced their shares outstanding by 4.4% CAGR annually, which means a significant portion of Apple revenue is going to buying back its own shares. And that is one of the main drivers of the share price growth of Apple in the recent years, as we saw that there is minimal growth in the revenue and operating cash flow of the business. Apple is currently trades for a price to earnings of 39 and a forward price to earnings of 32. If we compare this to their 5-year average price to earning, which is equal to 30, it seems Apple is trading at a significant premium today, even compared to its own historical multiples. In terms of price to operating cash flow, it trades at a price to operating cash flow of 35, which is again, compared to the 5-year average price to operating cash flow of 25 for Apple, seems to be on the expensive side. In terms of profitability, Apple has an exceptionally high return on equity of 149%, but this number is mainly due to aggressive buybacks. Their return on assets is also equal to 24.5, which is a better indicator of profitability of Apple. They also have 30% operating margin and 24.3% profit margin, which are great figures in terms of the profitability of the business. Overall, I think while Apple revenue is predictable and stable, and they have great profitability figures, I think the valuation of Apple stock is definitely expensive even compared to its own historical values, especially considering that Apple growth is slowed down and they are pretty much lacking any sort of innovation or any new exciting product in their pipeline. For those reasons, I would put Apple into overvalued category. Next, let's look at Microsoft. Microsoft share price grew almost 1,100% in the last 10 years, which is absolutely amazing. Microsoft market cap is now $3.85 trillion. That's a really massive company. Let's first look at growth numbers. The revenue in the last 10 years is grown by 11.2% CAGR, and it is consistently growing. Even if you look at quarter-over-quarter figures, it is still growing nicely. The Microsoft revenue is also very stable due to consistent cloud growth and high margins, reflecting the quality and recurring nature of its subscription-based revenues. When we look at operating cash flows and free cash flow growth, we can see even better numbers, around 16% CAGR growth for operating cash flow and 13% free cash flow growth in the last 10 years. Again, really amazing growth numbers here, especially if you consider the massive size of this business. Like Apple, Microsoft is also buying back shares, but at a much more modest rate of 0.78% CAGR, which means Microsoft use a good portion of their cash flow to reinvest in themselves to ignite growth. Microsoft is currently trades for a price to earnings of 37 and a forward price to earnings of 33. If we compare this to their 5-year average price to earnings of 30, which is again 33, it seems Microsoft is trading at a slight premium compared to its own historical multiples, but we should also consider their premium quality business and rapidly growing revenue, which means the valuation is not that crazy for Microsoft. In terms of price to operating cash flow, it trades at a price to operating cash flow of 28, which is again compared to the 5-year average price to operating cash flow of 20.57, seems to be close to its historical multiples. In terms of profitability, Microsoft has a high return on equity of 33%. Their return on assets is also equal to 14.2%. They also have 44% operating margin and 36% profit margin, which are all great figures in terms of the profitability of this business. Overall, I think Microsoft revenue is predictable and stable, and they have great profitability figures, and based on quality of the business and high growth rates, I think the valuation of Microsoft stock is actually slightly higher than the fair basically valuation. It's not cheap by any means, but it is not that expensive even compared to its historical values. For those reasons, I would put Microsoft into a slightly overvalued category. Next, let's look at Google. Google share price grew over 600% in the last 10 years, which is again a great performance. Google market cap is now close to $3 trillion. That's another super massive company here. Let's first look at their growth numbers. The revenue in the last 10 years is grown by 18.6% CAGR, and it is consistently growing. Even if you look at quarter-over-quarter figures, it's still growing very nicely. The Google revenue is highly dependent on the ad revenue generated from Google Search and YouTube, but they have a lot of different avenues to diversify their revenue in the future, from their hardware arm and with Pixel and Nest products to their Google Store revenue, monetizing their AI model Gemini and Waymo. So I think the revenue is probably going to continue to grow consistently in the future. When we look at operating cash flow and free cash flow, we can see even better numbers, around 19% CAGR growth for operating cash flow and 18% free cash flow growth in the last 10 years. Again, really amazing growth numbers here, especially if you consider the massive size of the business. We should also note that Google has a relatively large share-based compensation program, which means a good portion of their cash flow will be used to pay for employees' compensation, but still it is growing very fast. Like Apple and Microsoft, Google is also buying back its shares, but at a rate of 1.1% CAGR, which means Google use a good portion of their cash flow to reinvest in themselves for future growth. Google is currently trading for a price to earnings of 26 and a forward PE of 23. If we compare this to the 5-year average price to earnings, which is 24.8, it seems Google is trading close to its own historical multiples. In terms of price to operating cash flow, it trades at a price to operating cash flow of 22, which is again compared to the 5-year average of price to operating cash flow of 18, seems to be slightly higher than its historical multiple. In terms of profitability, Google has a high return on equity of 34%. The return on assets is also equal to 16.8%. They also have 32% operating margin and 31% profit margin, which are all great figures in terms of the profitability. Overall, I think Google is probably going to continue to grow their revenue and operating cash flow very fast in the future. I think the valuation of Google stock is actually close to being fair. It's not cheap like a couple of months ago, but it is not that expensive even compared to its own historical values. For those reasons, I would put Google into fairly valued category. Next, let's look at Tesla. Tesla share price grew over 2,500% in the last 10 years, which is remarkable. Tesla market cap is now close to $1.4 trillion. It's a massive company, but a little bit smaller than Google, Microsoft, and Apple. Let's first look at growth numbers. The revenue in the last 10 years is grown by 42% CAGR, but it is slowed down significantly in the recent years, and even went down in the past couple of quarters. The Tesla revenue is a bit tricky to predict. Their core business is not growing as predicted before, but they have a lot of hype and promises around robotaxi networks and humanoid robots, which is something I can't really predict. For those reasons, I consider Tesla revenue to be volatile and not stable compared to the previous company we analyzed. When we look at operating cash flow and free cash flow, again, we can see these figures all over the place. It goes from negative to positive, to growing significantly, to negative again. So it's really hard to predict their operating cash flow and free cash flow figures here. Unlike Apple and Microsoft and Google, Tesla shares outstanding is growing, which means the owners of the company have less and less ownership in the company by just holding the stock, which is not great. Tesla is currently trades for a price to earnings of 252 and a forward price to earnings of 172. If we compare this to the 5-year average PE, which is 131, it seems Tesla is trading higher even compared to its own historical multiples. It is expensive. In terms of price to operating cash flow, it is exactly the same story. The stock seems expensive. In terms of profitability, Tesla has a low return on equity of 8%. Their return on assets is also equal to 2.9%. They also have 4% operating margin and 6% profit margin, which are not really great numbers for a company that is considered a tech company, not a car company. Overall, I think Tesla valuation is extremely exuberant, and I can't justify these multiples for a company that struggles to grow, their cash flow is not predictable, and has a very weak profitability matrix. I would put Tesla into extremely overvalued category. Next, let's look at Meta. Meta share price grew over 600% in the last 10 years, which is a great performance. Meta market cap is now close to $1.7 trillion, which is considered small compared to Microsoft and Apple, but it is still massive in reality. Let's first look at growth numbers. The revenue in the last 10 years is grown by 27% CAGR, and it is consistently growing, even if you look at quarter-over-quarter figures. It is still growing very fast. The Meta revenue is like Google, highly dependent on ad revenue, but they are working on new ventures like Metaverse, VR headsets, their AI-enabled glasses, and their AI models. When we look at operating cash flow and free cash flow growth, we can see even better numbers, around 30% CAGR growth for operating cash flow and 27% free cash flow growth in the last 10 years. Again, really amazing growth numbers here, especially if we consider the massive size of the company. We should also note that Meta has a relatively large share-based compensation program, which means a portion of their cash flow will be used to pay for employees' compensation. But anyway, the cash flow is still growing very, very fast. Meta is another company that's buying back its shares at a rate of around 1% CAGR. Meta is currently trades for a price to earnings of 25 and a forward price to earnings of 24. If we compare this to their 5-year average price to earnings, which is 24.7, it seems Meta is trading right at its historical multiples. In terms of price to operating cash flow, it trades at a price to operating cash flow of 17, which is again, compared to the 5-year average price to operating cash flow of 15.5, seems to be in line with its historical multiples again. In terms of profitability, Meta has a high return on equity of 40%. The return on assets is also equal to almost 18.5%. They also have 43% operating margin and 40% profit margin, which are all great figures in terms of profitability of the business. Overall, I think Meta is still growing really fast, and they have a lot of high-risk, high-reward bets in their pipeline, which may contribute to continuous growth of their business. They are also trading at reasonable multiples for both earnings and cash flow, and for those reasons, I would put Meta into fairly valued category as well. Next, let's look at Amazon. Amazon share price grew over 700% in the last 10 years, which is again a really nice performance. Amazon market cap is now close to $2.3 trillion, and the company is massive. Let's first look at growth numbers. The revenue in the last 10 years is grown by 21.9% CAGR, and it is consistently growing. Even if you look at quarter-over-quarter figures, it is still growing. Amazon has also a lot of avenues to grow their revenue in the future, from AWS to third-party sellers to advertisement and to robotics and their autonomous taxi. So when we look at operating cash flow and free cash flow growth of the company, we can see great overall trend. Amazon is usually invest most of its cash flow back into their own business to grow. They had massive investments in warehouses, distribution networks, and recently cloud infrastructure. So a bit choppiness in cash flows is because of these reinvestments. But overall, everything is moving towards upside in the long run. Amazon, like Tesla, is another company that does not buy back its shares, and the shares are increasing at a rate of around 1.3% CAGR. Amazon is currently trades for a price to earnings of 33 and a forward PE of 28. If we compare this to the 5-year average PE, it seems Amazon is trading below its historical multiples, but in this case, I think the earnings historical multiple is not a good metric to look at for a company like Amazon. Operating cash flow is the best metric to evaluate Amazon with. In terms of price to operating cash flow, it trades at a price to operating cash flow of 19, which is compared to the 5-year average price to operating cash flow of 24, it seems Amazon is now trading at a discount. Amazon return on equity has historically been lower than pure play software peers due to the high capital needs for e-commerce. But the recent efficiency in their warehouses and distribution network are basically boosting this number as well. The return on equity is equal to 24.8% and the return on assets is equal to 7.7%. They also have 11% of operating margin and 10% profit margin. Overall, I think Amazon is still growing fast. They have reinvested most of their cash flow back into their business to grow faster, and they are firing on all cylinders at the moment. Based on operating cash flow metric, I think Amazon is slightly undervalued at the moment, and for that reason, I would put Amazon into my slightly undervalued category. The last but not least, let's look at the king itself, Nvidia, the largest company in the world. Nvidia share price grew by almost 30,000% in the last 10 years, which is unbelievable. Nvidia market cap is now close to $4.5 trillion. That's a really massive company here, larger than a lot of countries' GDPs. Let's first look at growth numbers. The growth in Nvidia revenue is explosive in the last 2 years. Just look at quarter-over-quarter numbers and see this massive exponential growth in the revenue of the company. This is definitely the crown jewel of AI boom. When we look at operating cash flow and free cash flow growth, it is the same story. Massive jump in the last 2 years. They also had a slight increase in their share count by 1% CAGR in the last 10 years, but in the last 5 years, they actually started to buy back shares and reduce the share count by 0.3%. Nvidia is currently trades for a price to earnings of 53 and a forward PE of 29. If we compare this to their 5-year average PE, it is actually in line with historical numbers. In terms of price to operating cash flow, it is trading at a 59 times of its operating cash flow. This looks expensive, but you should also consider that the company is growing fast. In terms of profitability, Nvidia has a high return on equity of 109%. Their return on assets is also equal to 53%, which shows their excellent capital allocation. They also have 60% operating margin, 52% profit margin. These are all amazing figures in terms of profitability. Overall, I think Nvidia is an extremely profitable business, and it is the crown jewel of AI boom. And it seems they are still going to grow fast. So the current valuation is not unreasonable compared to the quality of this business. I don't think the stock is cheap, as a lot is already baked into the valuation, and because we don't really know for how long the AI boom will last and if there will be more competitors for Nvidia in the future. Despite a 59 times price to operating cash flow, which seems really high, the stock is not that expensive when you consider the current growth rates of the business. And for those reasons, I would put Nvidia into a slightly overvalued category as well. There you are, guys. Magnificent 7 stocks are not only expensive, they are premium businesses, and they are expensive for a reason. Their high valuations are mostly due to their unparalleled ability to generate massive cash flows and use shareholder equity with astonishing efficiency. Between these 7 companies, I believe the valuation of 5 of them are not unreasonable given the quality of their businesses. I personally think Apple and Tesla are the only obvious expensive ones among the Magnificent 7 stocks. While the risk of market correction is always present, I believe even now at this massive size, Magnificent 7 stocks are not too expensive in general. That's it for this episode. I hope to see you guys in the next episode as well. Farewell.